Welcome. My name is Michael Norris. I'm the senior agent and president of the Norris Financial Insurance Group. Today, we're talking about why do the wealthy invest in life insurance? See, I get asked this question very regularly. In fact, almost weekly. Why do the rich invest in life insurance? It's not always for the death benefit, but many times for the great return on their money. Inside every permanent life insurance policy is a sub-account, and this sub-account is called a cash value account, and that's where the wealthy concentrate. Before we dive deep into a cash value account and how it works, let's see who invests in life insurance. We know the wealthy have been investing in permanent life insurance for years. Also, almost every bank president and Fortune 1000 CEO has a permanent life insurance policy in their portfolio. Not necessarily for the death benefit, but many times for the good return on the cash value account that can be withdrawn tax-free regardless of their income. Also, football coaches. After Louisiana State University won the 2020 college championship, Coach O's contract was renegotiated. One item, a permanent life insurance policy. Yes, it had a death benefit, but it also had a cash value account with a very nice return that can be withdrawn tax-free regardless of his income. Once again, inside every permanent life insurance policy is a sub-account called a cash value account. In my opinion, cash value is one of the least understood financial products on the market because most people think about it like a microwave. You have a leftover pizza, you want to heat it up, you put it in the microwave, you turn the dial, push the button, and it warms it up. That's not how cash value works. It's not just one item, one thing that it does. It's like a stove. Yes, it can heat up that leftover pizza, and let's be honest, it does a much better job than a microwave. But you can also bake a cake in it. You can fry fish, or I have 3 children, so when I have to help out with dinner, I grill hot dogs on it. Cash value can work how you design it and your purpose. It's not just a one-size-fits-all like a microwave. The original purpose of cash value was to allow an insurance policy to stay in place. Very quickly, the wealthy learn that there's a second advantage, a large tax-free return on money if designed correctly. The return on cash value was so profitable, guess what happens when something's too good? Yep, the government gets involved. As a result, the insurance policy no longer designs the cash value. The cash value account now designs the insurance policy. There are 4 types of cash value life insurance policies. We have whole life, and this is the one that many people use. It's probably the most popular one because you can design it to either focus on the death benefit or focus on the cash value account. There's also universal life. Most of the time, people are using that for death benefit. Index universal and variable life, most of the time, focus on the cash value return on there. Today, we're going to look at whole life and the index universal life policy. Life insurance policies that focus on the death benefit. So these are the ones that focus on the death benefit. We try to make sure that they last as long as they're paid correctly. And the way this works is we reduce the return on the cash value. But what we're going to do is we're going to increase the death benefit. As a result, many times we can make this policy paid in full at retirement. So when I have a client that says, I need a life insurance policy that will last until I pass away, we'll do a permanent life insurance on them, and I will try to design it so that when they retire, it's paid for. It's like a car. It's paid up. You're done, but you still own it. So when you pass away, it does pay out to whoever your beneficiaries are for the amount that you took it out for. So you could live to 90, 95, and the life insurance policy is still there. The wealthy figured out another purpose. If you decrease the death benefit, you can increase the cash value. As a result, there's a large return on money. Life insurance can have a tax-free return on the cash value as long as the policy is active. But like we talked about, the government got involved in this because it was too good. So they created something called a modified endowment contract. We call it a MEC. That's what the industry calls it, a MEC. So you just wanted to let you know that that's the actual term you'll hear most people refer to it as. The idea here is that it's a term given to a life insurance policy whose funding has exceeded the federal tax law limits. In other words, the IRS does not consider this to be a life insurance contract anymore. The change in classification was brought about to combat the use of the life insurance designation for the purpose of tax avoidance. So how do we get a large return on our money and make sure the policy does not MEC? And so this slide is how to avoid a MEC and still receive a great return. We're going to look at the cash value. So as it grows, it increases, as you see on the graph. But we're also now going to take the death benefit, and we're going to increase it right along with the cash value. We're going to have a space between the cash value and the death benefit, and we're going to have just enough space to make sure the policy does not MEC. I'm going to show you one of the ways that the wealthy use whole life, and this is one of my favorite ways. So without a plan, we've saved up $1 million for retirement. I'm not sure if you've heard of the 3 to 4% rule, but it's very well known and common. It says that if you're going to live 35 years after you retire, you can only take out 3 to 4% in retirement and have a low chance of running out of money prior to death. If you start taking out 6, 7, 8, 10%, you have a much higher chance of running out of money prior to passing away. So we have a 3 to 4% rule. Let's just half that down the middle. Let's call it 3.5. So we saved up $1 million. That gives us $35,000 to live off of for the rest of our life. As we know, this is usually not enough. We really need 7 to 13% to live comfortably. So what the wealthy will do, they'll take a whole life policy and create a volatility buffer. And they don't need $1 million. They just need $750,000 because we're going to withdraw, let's just say 10% as an example. And we're going to have a whole life policy that's going to act as a volatility buffer off to the side. And it's going to have $250,000 of cash value in there. So we retire. Year one, we take out $75,000. December 31st came along and market didn't do so hot. So we're going to let our retirement account rest. And we're going to take out the $75,000 out of our whole life volatility buffer. So then year 3 and year 4 come along. Market did great. We're happy. We're taking the money out of our retirement account. But then year 5, market tanked. It went negative. It was not a good year. We're going to let our retirement account rest, catch up, and we're going to take the money out of our volatility buffer whole life policy. You see how this works? Market does great. You're taking it out of your retirement account. Market doesn't do great. You're going to let your retirement account rest, and you're going to take it out of your whole life cash value. Now, let me take what we just looked at and let's put it into a time in history of the market. Remember, we didn't start with $1 million. We just started with $750,000. In order to live, we need to take out 10% or $75,000. Average rate of return during this time period was 12.77. So January 1 rolls around, we took out $75,000. Market didn't do so hot. It did positive 3.99. As a result, our account balance dropped to 701,933. However, year 2 and year 3 rallied, did great, positive 14.33 and positive 18.94. After the end of year 3, so December 31st, we have a balance of 763,324, more than we started with when we first retired. However, then the negative hit, negative 14.79 and negative 26.54. Remember, negative 26.54 is not the lowest the market has dipped. It's dipped below that several other times, including 2008, when it dipped almost 38 points. As a result, our account balance drops to 375,763. Even with year 6 and year 7 rallying at positive 37.25 and positive 23.67, we could not recover from that year 5 loss. And year 14, we ran out of money. That is without a plan. Let me show you what the wealthy do. Once again, we have an average rate of return of 12.77. We're taking out $75,000. Year 1, market did 3.99. We're not happy with that. We're going to let our account balance rest, and we're going to take out the $75,000 out of our whole life volatility buffer. Then we hit the negative years. Look, negative 14.79. So what are we going to do? We're going to let it rest, and we're going to take that $75,000 out of our volatility buffer. I purposefully designed this with only 2 years of volatility buffer protection just to show you the power of how this works. Normally, most all of my clients, we have many more years of volatility buffer, but I just wanted to show you this just with 2 even with it getting hit at the next year of negative 26.54. Remember, we started this with $750,000 initially in our retirement account. By the time we hit year 20, look, we are at positive 932,728. That is much higher than our original start of 750 20 years earlier. That is the power of the volatility buffer, just with even 2 years of protection in there. Like I said, we normally do a lot more than this, but I just wanted to show you the power of how this works and why the wealthy invest in permanent life insurance. We're going to change gears now. I'm going to show you why the wealthy are in love with index universal life insurance. One of the reasons is that the cash value actually follows the market. The most popular is the S&P 500, but there are other choices. It is best suited to satisfy longer-term needs of policy owners who want the opportunity to earn higher interest rates based on equity market performance. We're going to start with the downside of this one. There is a cap on what you can make each year. I've seen the cap as high as 16 points, as low as 10. So for the sake of our conversation today, let's just say 12. So if the market goes 14 points that year, you're only going to make 12 points. So you're thinking to yourself, why would anybody like this policy? Because there's a floor. When the market dips negative, you don't lose any money. So the market can dip negative 14 points. You didn't lose any money. You just didn't make any that year. As a result, you won't spend a single day of your accrual making up for losses. This is a very popular policy. Let's look at an example. Let's look at our buddy Joe. Joe's doing everything right. He's contributing to his company's 401k, but he knows not to go over the match. He's just matching up to his company's what they match. He's got money left over. He wants to invest in retirement. He's going to put $500 a month towards a high return cash value life insurance policy. Now remember, this is a life insurance policy. So if he gets critically or ill or needs long-term care, there are riders involved with this that he can put on there that he can take out money of his cash value, or many times he can actually use part of the death benefit. Yes, you can actually take part of the death benefit and use it while you're alive for critical illness and long-term care. It is a life insurance policy. So if he passes away prior to retirement, there will be money for his family. There'll be the cash value plus the death benefit. But that's not why Joe likes this policy so much. He knows that if he contributes $500 a month, it's estimated by the time he hits 65, he should have $500,000 tax-free regardless of his income. Let's look a little closer at what this will do. If he starts taking money out at age 68, he can take out $60,000 a year, completely tax-free, have a non-taxable income stream until age 90 in our example. So in our example, he contributed $168,000. Remember, there's a death benefit for when he passes away, but there's also the cash value. So when age 90 comes, Joe has withdrawn a total of $1.5 million non-taxable income. So the answer is, why do the wealthy like permanent life insurance so much? The significant tax-free returns. If you would like for us to put together a personal illustration, above or below this video, depending on what medium you're looking at, should be a link to my calendar. My team and I will gather some information from you and put together a personal illustration just for you so you can see how this will work for you and your family. Do me another huge favor. If you have gained something from our time together, tell your friends. Most of our business comes from referrals, and that's the highest compliment that I can get, is you referring a friend or a colleague to me. Like I said, below or above this video is a link to my calendar. Click it. Let's find a time to get together and talk a little bit about you. And I'd love to show you how this can work for you and your family. Have a great day.